You need to be focused on the best resources possible. Cost is king.
There's a bit of an industry nervous tick that everyone says they're in the lowest cost quartile. However, we genuinely believe we are.
Okay, very interesting, Matt. It was great to have them on really in detail for the first time. The market value of Standard Lithium is much lower than it was when they were much further away from production. So in my opinion, Standard Lithium, they're going to be first. And, for me, it's not a question of if, it's a question of at what cost of equity capital.
The point that Andy made, which I think is very important, is that the capital intensity for this project might be high, but the capital intensity for future projects won't be as high as for the first project. And then the other point that's very important to me is the OPEX. And we all talk about sort of OPEX and being below or towards the bottom of the cost curve. But the OPEX for these projects could genuinely be around the bottom of the cost curve.
Very good. Let's leave it at that and enjoy the interview. Welcome back to Rockstock Channel. It is Tuesday, July 28th, and today we're joined by Standard Lithium CEO David Park and Chief Operating Officer Andy Robinson, Dr. Andy Robinson. Standard Lithium has been developing a series of brine projects in Arkansas and Texas over the past 8 years. Lithium brines generally occupy the low end of the industry's cost curve, and they are particularly well suited to producing lithium carbonate, the chemical at the heart of LFP batteries, which is increasingly being called upon to power grid-scale energy storage supporting AI infrastructure, defense applications, and affordable electricity. As the lithium industry has and continues to grow 3 to 5 times as fast as global GDP, many more new projects across conventional and unconventional rock, clay, and brine will be needed to be developed in existing and many new jurisdictions. As I argued in my latest Lithium Bull newsletter, I see the potential for the USA over the next 10 years, using resources in our country and those from North and South America to move from a net importer to a net exporter of lithium chemicals, as we did in oil and gas over the last 15 years. The shale revolution, which has enabled this American energy dominance, started with industry pioneers applying American innovation into new resources, adjacent to critical infrastructure and a skilled labor force. Thanks to Standard Lithium's pioneering work in the Smackover, Big Oil, Exxon, Chevron, Koch, and Standard's joint venture partner, Equinor, have invested hundreds of millions of dollars, seeing a similar opportunity to innovate from 60-plus years' worth of oil, gas, and bromine operations, and to help power American battery energy dominance. Matt and I will be conducting a series of interviews with Standard Lithium in the coming weeks and months, as it progresses to financing and final investment decision for the first of several projects. For today's introduction, we will start with Andy and the vision that brought him, his partner Rob Mintak, and legendary Canadian business builder Bob Cross to the Smackover 8 years ago. And then turn to David and how his 30-year career at Koch has prepared him to help the company realize the potential of creating a lithium province in Arkansas and Texas capable of supporting 100 to 150,000 tons of lithium production over time. Standard Lithium is listed on the New York Stock Exchange American and Toronto Venture Exchange, same ticker symbol SLI. Its current market cap is approximately $500 million US, and the company currently has about $140 million cash in treasury and no debt. SLI is covered by a number of sell-side analysts in the U.S. and Canada, including Evercore, Canaccord, BMO, and Stifel. For more information about SLI, please visit their website at standardlithium.com or on X at Standard Lithium or on their LinkedIn page. Feel free as well to reach out to us at Rockstock Channel at rkequity.com. Before we begin, please note that Standard Lithium is a subscriber to Arche Equity Services, but Matt and I are not financial advisors and nothing discussed today constitutes investment advice. This discussion is intended for informational and educational purposes only, so please do your own research and read the disclaimer at the end of this video. And finally, I'd like to thank our sponsor, Clean Elements, an investor group focused on providing growth capital for critical mineral developers focused on the energy transition. Clean Elements has invested over $30 million to date and is currently the largest shareholder of both Galan Lithium and Noah Lithium Brines, two companies developing high-grade lithium brine projects in Argentina. And with that, Matt, take it away with some of your questions.
Okay, thanks very much, Howard. David, Andy, welcome to the Rockstock channel. I guess I'll kick off with Andy since that's been ordered. Andy, you're co-founder of Standard Lithium, as Howard said in his introduction. What was it that attracted you to the Smackover in the first place?
Yeah, thanks. Hey, Matt. Hey, Howard. Nice to see you. So it goes back to sort of when I started working in the lithium business, which was back in 2014, working in salar deposits kind of in the US. So working in the Clayton Valley, developing DLE flow sheets for a couple of years, and negotiating and agreeing an offtake relationship with Tesla, and successfully working out that DLE could get lithium out of brines in an efficient way at that particular resource. That was done in partnership at the time with Mintac and with Bob, who was one of the investors in that previous company. We realized that lithium was broadly as an industry, was going to transform over the coming decades. We saw it, the start of the kind of new entrance into the oligopoly that existed at the time, a trend towards commodification of lithium broadly, and a requirement that assets in any sort of emerging market, you want to be a low-cost producer. And the best way to get there is scale and quality of the resource. And it was kind of one of those things. So this is 2016 when we were thinking about the genesis of Standard Lithium, doing kind of the groundwork necessary before we set the company up and did a reverse takeover and kind of went public. And it was kind of a global search that I undertook at the time for brine assets. I think I agree with your opening statement, Howard. I think brines can be the cheapest producer of lithium chemicals in an integrated flow sheet. And so kind of a global search, looking for scale, looking for quality, looking for producibility. That is a very much ignored part of the what's called the DLE story, but being able to produce brines, get them to the surface, do something with them, and then get them back underground again is absolutely critical. Often overlooked in a lot of the DLE stories, frankly. But we could see that both the extent of the Smackover was clearly huge. The quality of the brines on the data that were available at the time looked great. And clearly, we knew that there was an existing industry operating there that had been doing basically direct bromine extraction for 60 years. And so we kind of knew that the producibility was definitely there, right? And that was really what allowed us to form the business around entry into the Smackover, was that kind of that sort of vision, low cost at scale, was kind of really what gave birth to the whole thing, Matt.
Okay, great. And I mean, one of the central themes of Howard's introduction that you sort of touched on earlier, Standard Lithium's really a brine story, not so much a DLE story, or not simply a DLE story. Can you explain why that is such an important distinction?
Yeah, no, absolutely, Matt. The inherent value is in the resource. That has always been the focus of the business, is finding the very best resources. And so, when we were searching, it was looking for the largest, the highest grade lithium brine assets that we could find on a global basis. There was lots of learnings from kind of my experience in DLEs. We kind of knew also what sort of brines were more amenable and would be better to develop. So we're looking for simpler, from a geochemical point of view, something a bit simpler, easier to process that could be pumped, brought to the surface, lithium extracted, etc., in a relatively simple way. But yeah, it was really size and scale. Again, sort of back to earlier points, the ever kind of the growth of this business is you've got to be a low cost producer, and quality and scale is always the deciding factor. Doesn't really matter what commodity you're looking at. Quality and scale drives the business to be a low cost producer, and that was really the fundamental basis. So the Smackover is 1,000 kilometers, 600 miles end to end along strike. It's an absolutely gargantuan reservoir of brine. We knew the key areas where lithium concentrations were the highest. We've learned a lot more, certainly over the last 9 years. We've certainly got a lot smarter, but we knew where to start, basically. And that was kind of, how we kicked off the company back in 2017, was that kind of initial starting point in southern Arkansas. We've, since expanded, but that was where we started.
And I'm sure the infrastructure was a big help as well in terms of making the decision.
Yeah, it was actually fundamental, Matt. It again, one of the parts of these resources is you need to know how to get the brine out of the ground, do the processing, get it back in the ground again. As I mentioned, that existing brine processing industry that's been there for 6 decades was just amazing, and we were able to piggyback on some existing infrastructure through a commercial relationship and a partnership with Lanxess in Union County in southern Arkansas. That was an amazing sort of slightly serendipitous, honestly, the timing, but it worked out incredibly well. That exposure to producing assets, real brine that we could then kind of work on back in 2017 was an amazing starting point.
Okay. And sort of moving a little bit more downstream now, brines are a good source of lithium carbonate. Why do you think that is important for the United States today, in the context of the growth of LFP batteries and the applications for those batteries?
Yeah, it was twofold for us. One was that just from a project development and a risk point of view, we've got to build a large facility. We wanted to minimize technology risk, and frankly, converting brines into a lithium carbonate product is a pretty well understood flow sheet, getting to a battery quality carbonate. And so we reduced our development risk, Matt, and sort of our technology risk, which was important for the lenders and for people financing the projects. That's an important sort of checkbox. And then we saw sort of the writing on the wall, I think, that the sort of battery chemistry was evolving. And that I think we made the decision several years ago, when I think hydroxide was the flavor of the day. We made a decision to becarbonate, and I think that's held true. I think that's turned out to be a pretty decent decision based on where the market in North America is right now, and that general move towards LFP focused chemistries for a lot of the real growth sectors in North America. I think that was a reasonably sort of prescient move on our part to kind of do that. But it was a combination of factors.
Yeah. Given the fact that we're seeing this huge growth of LFP batteries for grid storage, for data centers, AI, for defense, do you think there's a potential for the US government to sort of get behind batteries at some point?
I think we hope to see that. I think there's a recognition, right? I mean, I think across all levels of government, there is a recognition that batteries are central to energy stability and security in North America, right? It's kind of like, it's a given. Everyone gets that. I think the support will develop. I think there's been a focus on the absolute, the what's the phrase, the point of the spear or whatever, the very, very knotty problems right from the start. And I think sort of a wider, more expansive focus may well emerge.
Okay, brilliant.
Matt, if I could jump in there,
Of course.
just adding to what Andy said, there's clearly a focus from this administration on the battery supply chain. I believe that right now their current priority is further downstream than lithium operation. So they're trying to solve for the missing midstream and then the battery manufacturing itself, with a belief, I think somewhat mistakenly, that lithium will take care of itself. A belief that it's a little easier to get lithium projects launched globally than it may be. So right now, I'd say the current focus is more downstream of us, but there is still attention on the lithium side.
Okay, great. And I guess one of the things that sort of differentiates brine from hard rock is the lower operating costs. What sort of costs do you think are viable on acreage across the Smackover? Just ballpark.
Yeah, I think sort of from an OpEx point of view, Matt, we show $6,000 a ton all in, basically, for our Southwest Arkansas Phase 1 project. That's with a lithium grade, kind of in the mid to high 400s, low 500s, that kind of range. Grade is fundamentally important in operating cost, as well as all ancillary power, water, etc.
Okay, so I mean, just to give some context, I mean the prices in the last cycle never fell that low, so it's it's a very low cost positioning.
And I think one thing I just also want to differentiate slightly is that that's based on 6 years of operating a full scale demo plant, processing 90 gallons a minute, produce it like running that 24/7, understanding real reagent pricing, real staffing costs, real utility consumption, etc., like going to a carbonate end product. So these are real numbers, so we feel comfortable with that. So we can get it lower as we move to East Texas, for example. The grade improves. We will see kind of a consistent OpEx reduction because of that increasing grade. So we'll see some benefits there. We'll see some, optimization of the flow sheet over time. We'll get the cost down. So I think there's a sort of an industry sort of nervous tick that everyone says they're in the lowest cost quartile. However, we genuinely believe we are, not based on sort of engineering assessments or flow sheets, based on what we actually do day in, day out at the demo plant. And what we see is that we're pretty comfortable that we will be a low cost producer that will be able to weather pretty much any pricing cycle that we've witnessed in the last decade. Frankly, that's why we formed the company, to be in that position, right? To be a low cost producer. That's the whole point. And so, yeah, I think we see some improvements still to come for some of the other larger, higher grade projects, but we're starting in a good place.
Okay, cool. Now, for sort of ignorant Brits like me who aren't really very au fait with the geography in Arkansas and East Texas, unlike very well-informed Brits like you who are, can you just give us an intro into the sort of different regions in the Smackover and how they vary in size and in situ lithium concentration and key issues?
Yeah, no, it's a huge formation. It runs right. It's very sort of eastern extent, Matt, in the Florida Panhandle, kind of runs up through Alabama, Mississippi, across the Mississippi River into southern Arkansas, and then continues in an arc sort of through northeastern Texas, and then sort of peters out broadly in central Texas, sort of somewhere between Dallas and Houston. So 1,000 kilometers, 600 miles along that whole distance. Everything kind of east of the Mississippi River. Some great rock, lots of oil and gas production from that area, but let's call them the trace elements, so bromine and lithium, like not such high concentrations. Lithium's typically a few, kind of broadly kind of Albertan grades, kind of like 40, 60 milligrams per liter, sometimes 70 in those areas, but so not terribly attractive for us. You kind of come the other side of the Mississippi River into Arkansas, and you start to see the grade. You start to see the grade climb there. So you like at sort of the couple hundred milligrams per liter, sort of around the Lanxess properties, into southwest Arkansas, where we're kind of seeing, through kind of 400s, low 500s in that area. And then when we get into the key areas in East Texas, we we're getting into higher numbers again. So we're getting into, truly Argentinian numbers. But we're in the Gulf Coast area. So we're in an area of pretty flat land. Interstate 30 runs like basically through our whole project area. There's rail, the existing oil and gas production, existing bromine production. There are chemical facilities, there's power, there's water, there are educated workforce who work in those extractive industries broadly. So it's a very attractive combination of a very large world-class resource with an existing workforce. We're working at Standard Lithium, we're working broadly over kind of a length of about 200 miles. In that, within that zone, we've got lots of centers of population, lots of workers, lots of infrastructure, kind of like closely mingled in with our assets, right? So it's kind of a nice combination.
Okay. So this probably makes us a little bit more reasonable then. Some people called the Smackover the Atacama of the US. Obviously, there's quite a lot of lithium coming out of the Atacama.
Sure.
So what sort of capacity do you think the Smackover could support over time, given that you told us
Yeah,
about
the
concentration limit?
total, like, I think the truly productive zones in the Smackover where we're going to see is really in southern Arkansas and East Texas. I think that's where the bulk of the development is going to be. I wouldn't be surprised if certainly we see north of 200,000 tons per year easily. It could actually be significantly bigger than that, Matt. It could be potentially, sort of when you add up what we know, it could easily be 400,000 tons a year coming out of the Smackover, kind of in those areas. It's significant. We do think it's going to basically be the center of North American lithium production. I think it lends itself really well to coexistent development opportunities as well. I think the kind of hub and spoke gets bandied around quite a bit. But the Smackover is probably one of those locations where you could kind of co-locate. There could be some partnerships. There could be some co-development for key infrastructure, key refining and processing capabilities, etc. Absolutely could be located in the Smackover just because of the geography and kind of just the nature of the resources there. So yeah, we see it. It's got 30 to 40 years of being probably North America's principal zone of lithium chemical production and processing. Is absolutely, I think, is the future for the area.
Okay, that's brilliant. And when I look at these sort of Smackover projects, these brine projects on the continental US, indeed, I see quite a similarity with offshore oil and gas in terms of the fact that you're dealing with quite a high upfront capex and then quite a low OPEX structure.
Yeah.
Do you think that's a reasonable sort of way to sort of think about the industry?
I think broadly, yes, Matt. I think there are some fundamentals of bringing brines up from relatively deep, gathering them and processing them and refining them, which lend themselves to higher capex, right? I think that's a practical reality. That said, we're in the first innings of these sorts of projects capex estimates. I think it's going to get cheaper on a per ton basis over time as as the industry fully de-risks, as the contractors learn how to build these cheaper, how the vendors learn how to provide packages cheaper and more efficiently, as the lenders get more comfortable with the risk profile, etc. I think on a capex basis, these projects will get cheaper to build, and obviously the opex is always good. So I think that's the likely evolution in the region. As we're going to see, whatever, 10 to 15 pretty large projects built out, I suspect, in the Smackover over the coming decades. Then I think we'll see on a capex intensity reduction over time.
And
Matt, I
if
think
we
that
look at
was
the
sorry,
go on,
Matt.
sorry.
I
Yeah.
think that was a great question from perspective the nature of the costs of the operation. However, I think the better analogy is what fracking and directional drilling did for a shale revolution in this country that led to energy dominance. So we saw there the introduction of relatively novel technologies open up previously uneconomic resources, and then have now become a strength of competitive advantage for our country in producing oil and gas. Very much similar analogy, and Andy, you may want to draw on it a little bit more, where direct lithium extraction is a relatively novel technology, which then can open up the brine resources in the Smackover.
Yeah, and that was it was an analogy that we drew kind of 10 years ago, Matt, was when we were looking for assets and brine assets. We kind of figured all of the truly high quality, large scale brine assets were broadly taken already. So the key ones, Hombre Muerto, Sal de Vida, etc., and obviously the Atacama. And that was really what took us to unconventional resources. We saw that sort of transition from the best conventional resources were kind of gone to then, okay, what are the truly amazing quality unconventional resources that need a slightly different flow sheet to unlock the value? That was where we saw the Smackover. So the analogy that we made multiple times is it's the Permian Basin. It's extremely large, extremely high quality. That's going to fuel the next phase of growth and development in an industry, but it needs a tweak on the technology to get the value out of it. So whilst we needed fracking to get the value out of the Permian, and obviously drilling long laterals cheaply, what we're doing is, we just need to tweak the DLE, get that right, and then that's really the Smackover is an extremely large, unconventional, high quality play that will be the basis for lithium production in the US and North America for decades.
Okay, I just wanted to come back to this capex thing because actually you made a really interesting point. I know it's a big surprise, but the point that was really interesting to me was that you implied that the sort of capex would fall over time as the industry became more au fait with the technology, and obviously. And I think the other thing that stands out for me is obviously you're right on top of an existing industry that's using a lot of their technology. And maybe that's a differentiating factor compared to the Andean brines, where each time you're sort of building a new project in that area, you're building at altitude, you're building away from infrastructure and away from people and everything like that. Whereas you guys, you're building each time close to people and infrastructure and can utilize that technology. So there is the potential for this capex increase in efficiency, if you will, over time.
Absolutely, Matt. And I think the key part, that's a very astute point. The other part that I would say, which is fundamental to that reduction in capex over time, is that the brine is the same. So whereas in the Andes, you go from one basin to another, the geochemistry from one, 10 kilometers away is fundamentally different than the chemistry over here, and this is the largest here. We're sort of blessed with a very homogeneous brine chemistry broadly. Now there are small variations, but from a processing point of view, it's basically the same brine. It's just that the lithium grade improves as we go into East Texas. And so What that allows us to do is not have to reinvent the wheel every single time. We can basically take our flow sheet, tweak it, optimize it, remove the bits that we don't need. And I think we've been very clear with the market. Actually, Matt, we've said we've taken a bit of a belt and braces approach on this first project. We've thrown the engineering team at it, and because we absolutely need it to work, like we can't take any processing risks with it. Absolutely has to work. And so we've got lots of fail safe, lots of backups, lots of stuff that, I think in our hearts, we know we probably don't need that unit operation, but because we have it, we absolutely know that it's going to work because we have a backup here. Like we're doubling down on lots of things. And so as we build through this suite of projects over the coming years, we can get a little bit leaner, but equally it's just vendor relationships, contractor, the more prosaic nature of building projects, frankly. And David will talk to that a bit in his Koch experience, but like the prosaic nature of these things is like you build relationships with vendors, you get better at designing and building and supplying packages of equipment together. You get cheaper suppliers. You know how to design these things. You know which fab shop and which fab yard to actually put the stuff together. You know how cheaply you can integrate it on site. And you have a pool of labor that's built them before, and you can use that pool of labor from one project. And that's actually how you make things cheaper in reality. And because we don't have to really change what we're doing from one project to the next, we're naturally going to get cheaper and more efficient at designing, building, and then integrating these projects.
And there'll be a learning curve where we'll be, when we get to operations, where we will be debottlenecking, and there will be production creep, et cetera, over time that will all drive our costs down.
Okay, brilliant. Well, I think that probably leads really nicely into a discussion of David's CV and experience in delivering major capital projects. So I'll hand it over to Howard.
Okay. Actually, before doing that, I just want to make, I guess, just some other comments and analogies. So there's a lot of oil talk and the shale moment here, for the Smackover, but it wasn't overnight that the shale just happened, right? Like you guys have built over 8 or 9 years, a lot of intelligence, again, as the pioneers in the industry. I don't know if it was, maybe David, you can correct me if I'm wrong, if it was Harold Hamm and Continental Petroleum, whatever it was that like started the shale revolution. I see Standard Lithium as that from, a shale perspective, but also I think Bob Cross on your board, he was involved in Bankers Petroleum. That was like a heavy oil success. And I think, David, you've had some experience in the Alberta, oil sands, so these are unconventional different types of unconventional resources, but similarly, it's just there's infrastructure and there's skills, right? And time and North American ingenuity, brought to bear in a market that needs, new resources. So I see all of that applying here. So David, we're going to go in future videos. We're going to go deeper dive into just overall the technology, the flow sheet, et cetera, and also the financing and the like. But David, you're new, 2 years, I guess you joined Standard Lithium, and your background is quite a bit different than, let's say, a Australian or Canadian, mining entrepreneur that, took a project, so you've worked at Koch Industries, which I have known for over 15 years. In fact, I showed lithium opportunities into Koch as far back as 2012, but it's like one of the biggest American companies that many people have never heard of, right? Because it's private. And so you were there for 30 years. So could you just, I guess, share what is Koch and its various business activities? How did Koch become like relevant for lithium generally and Standard Lithium in particular? And then I'd like to get into, and understand your experience there over 30 years and how that translates into taking Standard Lithium to realize its full potential.
Great. Thanks, Howard. So Koch Industries is a private company. It is, I believe, or at least was, the second largest privately held company in North America. Valued, let's say it's over $100 billion balance sheet, over 100,000 employees. Its roots were in chemical processing, then went into refining. They expanded that into pipelines and exploration and production. It then active trading a number of different commodities. And then in, I think, the early 2000s, the company was generating extraordinary amounts of cash from their legacy businesses. And they had a number of capabilities, predominantly operational and commercial excellence capabilities, that they were very interested in seeing what other industries they could apply those capabilities to and grow into. So then a diversification move started in the early 2000s that I was part of, and we bought into different chemical intermediates businesses. We got in the pulp and paper business. We got in electrical components and connectors. We got in the glass business, a number of different businesses. But the focus always was, where do we have capabilities to succeed? And where we can build. Focus of Koch has always been about invest for the long term based off economic fundamentals, build businesses, run them like you're going to own them forever. So that's kind of a quick background on Koch. I would say over the last 5 years or so, there was an interest in getting more growthy businesses in the portfolio. So we started looking at investing in taking minority equity positions in businesses in what we called the energy transformation, but then also in areas, other growthy areas like telecom, data centers, et cetera. So that's a quick background on Koch Industries. And it was in that last bit, when we were looking for growthy areas within energy transformation, that my team made the investment in Standard Lithium.
Okay, I remember, Koch created Strategic Platforms, which was kind of like a venture capital arm internally, in a similar way that Koch had invested in businesses for the long term and ended up buying businesses. It kind of, like your description, reminds me a little bit of like Berkshire Hathaway and how they, build and own businesses for a long time. But you did create, I guess, a venture capital arm, and that led you to make an investment, I think $100 million investment, Koch did, in Standard Lithium. But Koch also had a technology.
If I could, Howard, yes. So what we were looking for was investments that, we bought into the vision, the strategy. They had the right teams, so compelling stories, but where we thought we could bring what we called mutual benefit to the table. So we had some capabilities or technologies or processes that could then augment those investments. So they brought something to us, and we bring something to them. So very much in that vein, we saw Standard Lithium, its story of being a low-cost, domestic, environmentally friendly source of lithium for the energy transition or energy addition, very compelling story. And then, we also had a technology that was applicable there as well. So we saw an opportunity for us to be able to help the business grow, be a minority investor, but help them jumpstart what they were doing.
Okay, so David, that's great. We'll get into in future videos. I know you did have a technology at Koch that's now part of Aquatech, and Aquatech's a partner of yours. As I mentioned, we'll dive deeper into that in a future video, but I just want to understand.
I was just going to say, like, Howard, it was really interesting that, like, right as soon as the investment was made, like, the Koch team brought like a whole bunch of stuff. It wasn't just the DLE. Like, we had a problem at the plant at the time with some pre-filtration work. Like, we're struggling with we saw high reagent costs, and the Koch team just out of nowhere reached into their organization, said, actually, we got this membrane technology. We've got a pilot skid, and within a month it was on the site and it was running and it solved the problem. So it was truly actually a great partnership, like super helpful at the time.
And Howard, if I could just jump in on an unasked question, but how we get that, we'll figure it out. When my team originated the Standard Lithium investment opportunity, when I first heard the story, I was very skeptical. I was skeptical of Vancouver penny stock pre-revenue company with a story that was too good to be true. So our diligence standards when we went into this were incredibly high. It was, at the end of the day, it was the quality of the team and the quality of the resource they were sitting on that convinced us that this was something we should do. And it was visiting the demonstration facility and meeting the depth of the team that had been put together and understanding how thoroughly and methodically they had gone about their business that caused us to believe this was real. This was not just storytelling. And so I started off this one quite skeptical and came away, convinced enough to have our team make the investment and then ultimately end up in the seat I'm in today.
Great. Okay. Before you headed up that venture capital arm plus capabilities at Koch, though, you had a long history of managing large capital intensive businesses. So if we could talk to some of those and what lessons from Koch from those experiences translate most directly into kind of financing and building, a greenfield project now.
Sure. So I did spend almost 3 decades at Koch, started doing corporate development work where I was involved in making investments in and acquisitions in pipelines, chemical facilities, refineries, oil and gas, et cetera. Then eventually moved on to be the CFO of our Canadian businesses, which was a pipeline business, a few pipelines, an energy trading business, and an exploration production business, crude oil exploration production business. Ultimately had the honor of getting to run a crude oil exploration and production business, run Koch's business when crude was $12 a barrel in 1998, and learned very quickly that cost is king. You really need to focus your team. You have to have the right size team, but you need to be focused on the best resources possible. At that point in time, what we were doing was actually somewhat analogous to what Standard was doing, where things that seem very commonplace today were still somewhat novel. So directional drilling plus screw pumps, opened up heavy oil assets that were not producing before. Then the invention and application of steam-assisted gravity drainage opened up even additional oil sands resources. So we were very focused on trying to produce more Canadian heavy oil and introducing novel technologies to open up a resource. So that was over 20 years ago now, but got very familiar with oil and gas through that. Then I ran a business called True North Energy, which was a Koch subsidiary that was developing an oil sands mega project north of Fort McMurray, Alberta. Very, very deep, working with engineering, procurement, and construction teams, working with procurement teams, working with local communities, diving into the regulatory process, working with, frankly, a junior oil and gas company in a joint venture as our minority partner in that. So there were lots of things there that were applicable. After that stint, I was on point for new platform acquisitions for Koch Industries. That was when we were really putting our foot on the gas to diversify into different industries. I ultimately then led the acquisition of a business called Georgia Pacific, which was a $20 billion take private at that point in time. Led the deal, and then was asked by Charles Koch to go live with it. So I moved to Atlanta to make sure that we were driving change and executing on all the bets we had made. A number of those bets were commercial, a number were operational, and then we had others that were growth focused. So I ran a strategy. I was part of the executive team. I ran the strategy and corporate development team, where really all capital investment decisions of certain size ran through my group on the way to the board and on the way to the CEO. We were in charge of, my team was responsible for, industry point of view work, strategy, M&A, capital allocation, decision-making, all of that. And then after doing that a number of years, and where, there was no longer a full-time need for me to be a change agent, because we had successfully changed the way Georgia Pacific was operating. I then added on a number of different board seats of Koch companies. So Koch would acquire a portfolio company, I would go on the board, and then I would help the CEOs of those businesses, put in place the right systems, processes, economic thinking skills, et cetera, going forward. So that was a very long-winded answer. Howard, I don't know how you want to.
No, I wanted you to go through all of those experiences because like by comparison, I think this project, Standard Lithium's project, Southwest Arkansas First project, is, I think, headline $1.5 billion and will involve. We talked about this with John Evans and Lithium Americas. They have Bechtel, right? A $3 billion project. Like in the lithium world, that's a big project and that's complicated. But for Bechtel, it's not so complicated, right? And we were talking about developing the offshore oil industry and the high capital intensity of that. Like big oil, invests, a lot of money. And so the projects that you operated, that you just walked through, in terms of scale, I'm sure the dollar numbers were lower because of inflation or, since then. But like in terms of people and project size, how do those compare to Southwest Arkansas, your first project?
So the oil sands project at that point in time, Fort Hills oil sands project, we believed it was going to be about $1.5 billion project in year $2000. It was going to have 5,000 people at peak construction, materially more people in construction than, Andy, quote me if I get this wrong, I believe with Standard Lithium we'll have about 450 people peak construction. So, those projects in Fort McMurray were, I'd say, the getting through the regulatory process was actually a lot more intense than what we've had to go through at Standard, given the nature of the operations. And then in construction and, project execution, it was larger endeavor.
All right. So you made this investment and then you left Koch. So what made you leave Koch? And then how did you have a very short retirement and now come back to lead what used to be, a Vancouver penny stock?
Yeah. Well, first I'll say I had a great career at Koch. I'm very thankful for all the opportunities that were presented to me at that point in time. And I like to think I left it a little better place than when I started. That said, you work close to 30 years any place, particularly in a large organization. When you're, even if you're in a senior role, but there's 100,000 people, your opportunity for marginal contribution sometimes can get lost and in a large entity. And I frankly, I'd done well enough, and the day-to-day headaches were no longer worth it. I would put it that way, Howard. So no hard feelings with anybody, left on great terms, but I felt like I'd done what I was there to do at Koch, and was going to ride it out in Park City and enjoy myself, and perhaps do some advisory work on the side, but I didn't think I was going back in full time.
And then you joined as an advisor, and Rob Mintak asked you to take over and replace him. So this is a very different, you've never been a CEO of a public company, let alone one without the balance sheet of Koch, right? So here you are, 2 years in the bear market you joined. We've now had a bit of a recovery, although it's not reflected in your and many other stock prices compared to where, we could pull up a chart here of Standard Lithium at one point, during peak energy transition, Biden days, COVID. I think you had 1.5, 2 billion market cap. You're now at 500 million market cap, but you're much more advanced than you were then, I guess. So what, you had a nice retirement, you were comfortable, right? This is a very significant undertaking, not just this project, but also, the vision. If Andy was talking about 400,000 for the whole Smackover, maybe you could be 100 to 150, because you're not just Southwest Arkansas. You're about to come out with, I think, your second project, economics. This is very different from Koch.
Yeah, no, like I had really grown to like the team at Standard as I started to, from when I was in the investor role to then as the advisory role. And what I saw was just I had said to my wife and to my friends, if I come out of retirement, I want to work on something that's interesting. I want to work on something that's important. And I want to work with people that I want to, with good people. And this Standard had all of those ingredients for me. The value proposition was, the initial vision that Andy set out was real and tangible. There were some key strategic moves that needed to be made, and some of them have been made. The pivot away from a homegrown DLE technology to adoption of Kochs, that was a key strategic pivot. The move from hydroxide to carbonate was a key strategic pivot. But then there was one more pivot that needed to be made, and it was the pivot away from, I'll say, lower grade, smaller project at Lanxess to our Southwest Arkansas and East Texas projects. So there was an opportunity to work closely with Andy and the team to pivot this company towards focusing on really big, high grade resources. And then, what I learned at Koch, you can talk about specific capabilities and, what industries did you work on? But ultimately, the success of any business tended to come down to, do you have the right vision? Do you have the right strategies? Can you select and develop and nurture the right talent? Do you have the right incentive systems in place to make sure the team is focused on shareholder value and teamwork? And then do you have the right measures and systems to be able to make sure that incentive system works and you're rewarding the right things? Across all the different businesses, those are kind of key ingredients. And I thought I could help the team there. Frankly, they had done great work. Andy had assembled a really great team of people that had built projects and worked on projects in Canada. So whether you're talking about Steve Ross or Jason or Angus, our core engineering team, really solid people with great credibility and a lot of capability. Our head of procurement, Paul, also, a lot of EPC experience. So we had, and then we added Chad Martin to the team, who is a real, highly experienced critical minerals refining operator. So he runs our operations in the U.S. So Andy had done quite a good job, and Robert had done quite a good job of building a team, but there's more we needed to add, and I thought on the margin I could help the team jumpstart that and do it. So it was an exciting challenge, and I've loved it the last 2 years.
Okay, that's great. And just final two questions here. And again, we're going to have a lot more in subsequent interviews in coming weeks. But you recently joined the board of a company that I've referenced a couple of times in videos and in my writing, which is in the nuclear space, Oklo. And like, so you're a public company, you're listed in Canada, but as well as in the US. Like when you look at the US, critical minerals thematic, AI thematic, there's a lot of thematics going on there. And you have Chris Wright as the Department of Energy secretary. He's been very supportive of nuclear. I looked at Oklo. Oklo is a greenfield startup, very, very, very ambitious project. I looked at some research from Goldman. I think they're going to need $14 billion of capital and may not be free cash flow positive until like the mid-30s, 2030s. You can correct me if I'm wrong about that, but you're on the board of Oklo. And I'm just looking at that, like in Oklo's market cap, it was recently 10 or 11 billion. It's fallen a little bit, but it's still 10 times the market cap of Standard Lithium, and their CapEx need is also 10 times, right? So like for those that might be new to lithium, but they understand like the energy needs for AI and they're betting nuclear or uranium or whatever, like how should we think about this? I see this like, batteries versus, other forms of energy and how the administration is prioritizing things. But I see like a real disconnect if you just think about a business and its operational complexity and what is the cost of equity, right? Of these two, new builds, right?
Sure. Yeah, so that's a good question. So I was introduced to the opportunity through really two investment bankers that I'd worked with, one at Morgan Stanley and one at Citi, that are now very close with Oklo. So they had a board search going on, and they recommended me to go on the board because I'm day in, day out. Well, first, it was part of my background that we just went through at Koch, that we just went through. But then day in, day out at Standard Lithium at a smaller scale, as you point out, I'm living the same issues as the CEO of Oklo. So, we're building a team, pre-revenue companies, building teams, rapidly scaling, high interaction with the U.S. government, converting from remote operations to, building presence and, where people are all working in the same place together, having boards transition. So we're dealing every day with, some of the same issues. So the belief was I could help them and they could help me. So really what I would say is there's kind of a synergy where there's lessons learned on both sides, where there's a little cross-pollination happening. So, I think it's an interesting analogy. It is a lot bigger than us. They've been very, they gotten off to a quick start. But that said, Howard, Andy and I have very big ambitions on where we're going to grow Standard Lithium. We're not a one project company. We have a portfolio of companies in the Smackover Basin. We will, we're clearly an upstream player, but we're intrigued by opportunities further downstream from us as well. So at the right time, with the right capital, access to capital, we may venture further that way. And then, who knows? There may be other geographies that make sense for us to enter. We're looking at building, a very large business that is developing some world-class assets in a high-growth sector. So, it's very analogous to the Oklo experience.
And that's how I'm thinking of it. There's a lot of big ideas here, whether it be shale, offshore oil, big ideas like Oklo, and MP Materials is another one. Like when they came public through a SPAC, they were $1 billion, and now they're going into magnets and they have their 10X facility. So let's just final question, just I guess near term milestones, news flow that should be expected, because the market has really been focused on this kind of Southwest Arkansas, but you've said repeatedly you're a multi-project company. So what should we see in the next kind of couple of weeks and months?
Yeah, I would say we're driving the ship, highest priority. We're driving it towards a final investment decision this fall. For that to happen, you will need to see in short order some offtake announcements, and I think we're tracking very well with respect to offtake. So I'd say before the end of the summer, very, very optimistic that you'll see some positive news on the offtake side for Southwest Arkansas. Then the next step after the offtake will be finalization of the project financing discussions with the export credit agencies. And I think, as we've mentioned on other dialogues before or in the past, we're in very advanced stages of diligence and negotiations with the export credit agencies. They have circled over $1 billion of capital, which they would like to lend to us. That is all going very well. I would say the U.S. Department of Energy, we haven't mentioned that yet, I don't believe, but they have awarded us a $225 million grant for our project. That grant is in good standing, and our relationship with the U.S. DOE is extraordinarily strong. So we are in the process of teeing everything up for that final investment decision this fall, with initial production in 2029 and probably a fully ramped up production in 2030.
I think the other thing then is the PEA for the Franklin project in East Texas.
Thanks, Andy.
That's underway at the moment. Yeah, we expect to have that out towards the end of Q3. So I think that's going to be a very interesting study. So
I think nobody
like the scale that we're looking at there. Yeah.
I from my observation, looking at this industry, like companies have, I don't think the market's giving any value to anything beyond Southwest Arkansas, I guess is what I'm thinking. And because you have one PEA out there, or one definitive feasibility study out there, you're saying basically Franklin will be an opportunity to see economics for a second project. So in thinking of Standard Lithium as a potential 100 to 150,000 ton, you need to look beyond the 22,500 of Southwest Arkansas. And you're saying investors will be able to see economics of that sometime in the next couple of weeks and months.
Exactly. And again, just to reiterate that Franklin is only one of a handful in East Texas. So it's the first, and it's the most well-defined of what we have in East Texas, but then there are more beyond that. But I think the Franklin PEA should make for interesting reading.
So watch this space. Watch this space.
Yeah.
More news coming.
So that's great. Thank you very much, David and Andy, for sharing both, the origins of the vision, 8-9 years ago, and David, your very substantial experience at Koch that gives me confidence that you will help realize not only this, the first project, but projects, but also the idea of Smackover as a shale moment for American, energy dominance for an electro state, not just a petro state. A lot of things I talk about, I have good confidence in, and look forward to the milestones you articulated, but also doing deeper dives in subsequent videos in the near term. so people understand the depth of the work that you've done to date. So thank you, and look forward to talking to you again very soon.
Thank you, Howard. Thank you, Matt. Look forward to coming back at some point in time when you invite us.
Yeah, thanks,
Cheers,
Jeff.
guys.
Pleasure.